Hello and welcome back to the Unconventional Podcast with Grace Hardy. Today we're joined by Dan, so thank you so much for coming.
Thank you very much for having me on.
No worries. Would you like to give yourself a little introduction to the listeners?
Absolutely. So I'm Dan. I'm a mortgage advisor who helps home buyers across the country to buy their homes in the UK. I do work primarily in the first-time buyer market and helping to people to take those first steps onto the ladder.
Amazing. And so we're just going to get straight into it. This is going to be around getting mortgages for self-employed people and business owners. And so why do you think business owners think it's more difficult for them to get mortgages?
Firstly, in some ways it can be if you're not doing it properly. Secondly, there are quite a few mortgage myths online. There's a lot of misinformation out there online regarding the subject. I'm regularly approached by self-employed applicants who maybe believe that because they're self-employed, they're not going to be able to buy a home. However, that isn't the case.
So what is the biggest mortgage myth that you come across for self-employed people?
It's regarding the amount of evidence that they need to be able to provide. So there's a little bit of a myth that there are self-employed mortgage products and employed mortgage products. That isn't the case, okay? Self-employed applicants can access the same deals as everybody else. However, with self-employed applicants, you do need to provide more evidence of your income. Lenders view self-employed income as being a little bit more unstable, less reliable. I don't make those decisions, but those are the views of lenders. Some self-employed applicants may believe that they need 3 years accounts, 4 years accounts. That isn't the case.
And how many do they need?
So with many lenders on the market, the answer would be 2 years accounts. However, there are some specialist lenders who will allow a self-employed applicant under the right circumstances to apply successfully with 1 year.
Okay, and so if you were going to take 2 years, for example, would that be the average of the 2 years combined? Would they adjust it slightly more up, more down?
Okay, so most mortgage lenders on the market, I will say most a lot during this podcast because every lender is different, but most mortgage lenders on the market using the latest 2 years, assuming that the figures are increasing year on year, will use an average of the latest 2 years. If you are a sole trader, you will receive a tax calculation which will show your profit from self-employment. Lenders will use that figure for sole traders over the latest 2 years. If that's increasing, it will be an average of the latest 2 years. If you are a limited company director, you will again receive a tax calculation showing salary and dividends, but also company accounts, which will include your salary and net profit of the company. Now, what figures lenders use is dependent on the lender. Some lenders will use the tax calculation, so the salary and dividends for a limited company director. Other lenders will use salary and your share of the company net profit. It's the job of a mortgage advisor like myself to look at your figures, look through your accounts, and then to place you with a lender who's going to make best use of that income.
Okay, amazing. And so when you're looking for these things, what should, say, a limited company director have ready? What documentation should they have to give to you?
So I would request from all of my applicants your latest 2 years tax calculations, tax year overviews, and your limited company accounts. So if you are looking to apply, if you are looking to buy a home in the near future, you should be communicating with your accountant and making sure that those documents are ready for when you need them. At the end of tax year may come, your accountant doesn't need to file them straight away. However, if you are looking to buy a home, you may want to get those documents through. So yeah, make your accountant aware of that and hopefully they can provide them to you a little bit sooner.
And also it's really important to communicate with your accountant because obviously I am one, and we always look at tax efficiency because people come to us, they go, Grace, I don't want to pay a lot of tax, and I go, brilliant, noted, we'll sort it out for you. But when you're trying to buy a house, sometimes you need to increase your salary so that you can get a bigger mortgage, otherwise we'll put you on the personal allowance and then your salary is £12,570 and they're going to look at it and go, well, that's not going to work, is it?
Accountants sometimes can sort of default to tax efficiency, which is great. However, if you are looking to buy a home, you need to communicate with your accountant. That may be your primary financial goal over the next few years. So your accountant can work with your mortgage advisor in this case. So let's say, Grace, if you were to approach me and say, right, Dan, in 2 years' time, I want to buy a home for £450,000. I would then tell you, well, looking at your debts and how many children you've got and your credit score, your income needs to be X. You would then have that clarity. For me to buy that home over the next 2 years, that's what my income needs to look like. You can then have a chat with your accountant about how you can make that happen. In which areas do you need to increase the money coming in, your turnover? In which areas do you need to decrease expenses perhaps? How is it you can make that happen? And that means you're going to move through the next 2 years with your accountant on side, your mortgage advisor on side, all working in one direct line to home ownership, and yeah, making sure that there's no unnecessary mistakes and everybody's on the same page.
100%. 100%. And so how do you think accountants and mortgage advisors can work best together? And how far in advance should you be having a conversation with a mortgage advisor like yourself when you're looking to buy somewhere?
So firstly, it's never too early to speak to a mortgage advisor. Reason being, it's never too early just to lay some solid foundations. So you might say, right, Dan, I'm looking to buy a home in 4 years' time. I don't really know how it works. I don't really know how much mortgage lenders will lend. I don't know what it means if I've got debt. I don't really understand credit scoring. But have a conversation about it. That will also, and lay some solid foundations, which will then give you a good footing for successfully moving forward. Preparation is absolutely key. You can never prepare too early. A lot of the time I'll speak to people who will get there further down the line when it's time to buy a home. They haven't had a conversation with a mortgage advisor yet. And sometimes it can be too late. Maybe they do have a few credit issues. Maybe they do have too much debt.
Yeah.
Maybe the income's not quite where they need it to be. That doesn't mean that they can't buy a home in the future, but if they wanted to buy a home right now, sometimes it's not going to work. Whereas if they just had that conversation 2 years ago, they would have known, right, maybe I do need to get rid of that credit card debt.
Yeah.
Maybe I do need to improve my credit score, whatever it may be. So it's never too early to have a conversation. In terms of how mortgage advisors can work with accountants,
yeah.
So it's just communication. So when I work with my home buyers, one thing I always say to them is, to save you a job, let's imagine it's you, Grace, to save you a job, I'm happy just to speak with your accountant directly, with your permission. Reason being, I might sometimes, although we try to avoid it, I might speak in mortgage advisor lingo. Sometimes your accountant may speak in, although you are an accountant, so maybe got not a good example, your accountant may speak in accountancy lingo.
Yeah.
We'll understand each other.
Yeah.
Because we understand what the documents are, we understand what we need. That can just save you a job as a home buyer. You've got enough to worry about. You probably don't want to worry too much about exactly what a tax calculation is or a tax year overview is. So allowing and giving permission for your mortgage advisor to speak with your accountant directly can save you the hassle, streamline the process.
Amazing. And so why do you think that self-employed people's income is seen as less unstable?
One, because it can be. There's so many things can impact a business.
Yeah.
It maybe is less stable than somebody who is employed on a salary, where there's a contract in place. There's maybe certain terms in place where they can't just lose the job.
Yeah.
So in some cases it can be. I understand that can be difficult to hear sometimes, and I'm self-employed too, so I've got to jump through the same hoops, because we may think that we've actually got more control of increasing our income
for sure.
than an employed applicant. But yeah, it's just because, especially after the pandemic, so many businesses were affected by COVID and everything that happened there. So lenders are even more cautious now than they were before. So yeah, but you've just got to work with the lender, find the right lender, and lenders do want self-employed applicants. They do want to lend you money, believe it or not.
Really? Oh my God. I just remember when I was like 18, 19, I was obviously employed as an accountant. Shock horror. I was looking to buy a house, and it just seemed so much easier than it was now. She was like, spoke to a mortgage advisor. She was like, yeah, you need your 3 months pay slip. And I was like, brilliant. Anything else? She was like, any debt? I was like, no. She was like, fine, that's it then. And then she was able to give me a figure of how much I could look to buy a house for. I was like, oh my God, that's so easy. And then I remember I was like, right, I'm going to make the jump to be self-employed now. And then my mum turned around to me. She was like, well, you won't be buying a house for the next 4 years. And that is something I had to like almost come to terms with, being like, okay, well, I don't have the stability of buying a house anymore. I'm going to have to commit to renting or whatever it may be for the next 4 years. And that was kind of quite scary.
So yeah, and that absolutely can be the case. It can be a weight. As well, as much as anything else, it's not just providing the documentation. It's also building your business to where you want it to be. It can take time to gather clients, to begin to increase your income. That takes time. As mentioned earlier, in some cases, you might be able to get a mortgage with 1 year's accounts. It's not for everybody. It's not with every lender, but it can happen. So I'll give you an example of that. Last year, I worked with a business owner who his business was essentially selling seafood en masse. So at the time, he had a contract, the Taylor Swift tour was on, and he was supplying the seafood to that tour amongst everything else he was doing.
Oh my God, brilliant.
So yeah, it was a successful business at that point with only 1 year's accounts. As well as that, he was able to provide to me evidence of, Dan, I've been in this industry for 10 years. I've worked in all of these huge restaurants around the world. I've won these massive awards in the industry. He sent me newspaper links of these awards that he'd won. And all of this was genuine information that I then provided to the lender.
Yeah.
With that information, so his history of working on an employed basis, the success of his business in the first year, and also a projection from his accountant for the next year was enough in this case to buy a home after only 1 year. So it is possible with the right circumstances.
That's amazing. Who knows, seafood could be so lucrative.
Who knew?
And so what has been your personal mortgage journey? What made you get into it?
So I bought my first home in 2018. I was 26 years old. I worked in finance and had done for years, but I wasn't actually a mortgage advisor. I didn't really have a lot of knowledge around the mortgage process, as many people don't. My partner actually took the lead out of the two of us, ironically now, and sort of took us through that process with the advisor. The mortgage advisor that I used was simply a recommendation from a colleague. I didn't know who he was. I didn't know anything about him. I just didn't know any mortgage advisors. So when I was given a number, I worked with this person and it wasn't great. I didn't enjoy it at all. He spoke in jargon. I felt like he didn't want to be there. He didn't welcome questions and I felt like he wanted to be in the appointment and out of the appointment. It was very transactional and we didn't have a great experience, and neither of us, to be honest, liked him, which doesn't really help when it's the biggest financial transaction of your life and it's such a daunting process. So that really made me think, surely it can be done better. Surely the service can be more personable. It can be more relationship based. So yeah, that was 2018 and I qualified in 2020 and began working as a self-employed advisor from that time. But yeah, my experience sort of inspired me to make it more of a relationship-based service, to really, with all of my social media, people choose to work with me after following me for months or years. So they already feel like they know me. I'm not just a number on a piece of paper. They've chosen to work with me because they like me or they trust me or they think I know what I'm doing. And that can give people a much better experience. I also think in our industry, Grace, so it'll be similar for yourself as an accountant, I do feel that the service is becoming less transactional and more relationship based. With the rise of AI, you might think wouldn't be the case. You would think it would become more transactional, more automated. But I think that's because with our generation, we naturally question things a lot more.
Yeah.
We don't just believe what's on the news all of the time. We know that some things are either leaning this way or leaning that way. We know that TikTok has a lot of misinformation. For example, Stephen Bartlett's podcast has been in the news recently for misinformation to do with health and fitness. So because of that, I think our generation maybe are less trusting and want to work with an individual who they can rely on, and whether that is an accountant, a financial advisor or a mortgage advisor. And I think that is hopefully improving the process.
I also think that we crave more human connection now, especially after COVID. And I feel like we want to actually educate ourselves more. We have more of an awareness of what we want to know and what we should know. All of my clients I come across, they want to learn things and they're eager. They weren't taught finance at school or how mortgages even work. And so they actually want someone to sit down and teach them, which I think is so amazing that you're so open to being educated, because a lot of people aren't. And I think with the rise of AI and digitalization, it will go one of two ways. I think you get two types of people. Someone that will see a free tax app on their meta ads where it's like, you don't need to pay accountancy fees, you can just do your self-assessment through here for free, and they're like, oh my god, amazing, and they'll just do that. And then there's other people that are like, I don't really know what I'm inputting into all of these boxes, I'd rather actually sit down with someone and do it that way.
There's so much choice now. Your business is available online, my business is available online, and there's many other people in my field doing the same thing. And I'm not going to be the advisor for everyone. Some people might want the grey-haired man in a shirt and a tie with a briefcase. That's not me, but there's nothing wrong with that. You can choose that. You can choose an advisor. You can choose myself. You can choose another advisor, whatever it might be. And I think the luxury of choice is there now. And I think that's certainly going to make people feel more comfortable and encourage relationships and choosing the right person for you. Because a relationship like a mortgage advisor or an accountant, it's not just a one-time thing. You might be working with me for the next 30 years. You might recommend me to your children in 25 years' time. So it's important that you do choose the right person. Give yourself the best chance of enjoying it. Because buying your first home especially can be stressful. There will be nights where you want to pull your hair out because your solicitor is doing your head in, to put it, quite bluntly. But, having somebody who you can call or send a message on WhatsApp now and say, Dan, I'm stressed about this. What's happening? Can you explain? That's, it's only going to give you peace of mind and help you to have a little bit of fun with it.
So now I want to have a small conversation with you about LISAs, lifetime ISAs. What are your thoughts on them?
Lifetime ISAs are a fantastic opportunity. So a lifetime ISA allows an applicant to contribute £4,000 annually and receive a 25% government bonus on top of that. Now, so if you contribute £4,000, that's £1,000 in free money from the government. That's pretty amazing, especially when it's so hard to save a deposit. The higher home prices, that free money can go a long way. And if you start contributing to it early, and if you are fortunate enough to be able to maximise that contribution, you can get quite a lot of that bonus and quite a lot of free money there, which can only help. However, there are some considerations to be made with the LISA about whether or not it's suitable. So you can only benefit from a lifetime ISA 12 months after making your first payment into your lifetime ISA. So if you're looking to buy a home in the next 12 months, it's maybe not for you. But what we would recommend is open a lifetime ISA as early as possible. Okay, stick £1 in if you've got no money. Start that clock ticking. Therefore, when you are ready to buy a home, it's hopefully already been open for 12 months and you're ready to use it and take the benefit. Another consideration is that the maximum purchase price with a lifetime ISA is £450,000. Now, in a lot of the country, that's okay. It is a little bit more of a sticking point in London, where house prices are so expensive.
I saw today they were like the average house price in London is over £600,000.
That's crazy. And the average age of a first-time buyer is going up. The average age of a first-time buyer now is 34.
Are you running a business? Meet your new best friend, Sage Accounting Individual. Whether you're testing an idea, managing a side hustle, or running a full-time sole trader business, Sage makes digital record keeping a breeze. You can connect your bank, categorize transactions, and create professional invoices in seconds, and send them to customers in a click. You can even understand your profits, track who owes you money, and get your taxes sorted from your laptop or your phone. If you need a helping hand, you can get instant support from our Sage specialist via web chat, or connect with an expert accountant like me for expert business advice. With Sage, you can focus on what matters, growing your business. Join over 1.2 million UK businesses already using Sage. You can start for free today by visiting sage.com.
Especially in London, there's a lot more of a renting culture. But by the age of 34, that may be considered a typical age for starting a family or having a family. And at that time, you might want more of a family home. For £450,000 in a lot of London, that's just not possible. So yeah, be cautious of that. If you are in certain areas or you're hoping to buy in certain areas or a certain type of property with a higher value, before you put all of your money into a lifetime ISA, you need to consider whether it's going to be suitable for the property that you're looking to buy. If you have to withdraw that money for any reason, maybe you're not using it for a suitable home purchase or you're not using it for retirement, then there's a 25% withdrawal penalty on that, which can mean that you will end up with less money than what you put in, which nobody wants.
No, and I think that's really important, and I'm so happy that you highlighted that, because obviously as a skeptical accountant, when people are like, what type of ISA should I be looking for? A lifetime ISA is great if you're not in London or really the southeast of the UK, and you do have to remember that you can only take that money out to buy property or retirement.
So what I see a lot of people whose money arguably becoming a little bit trapped. Let's say they started saving into a lifetime ISA 7 years ago. As many people should do, start building those funds 7 years ago, hoping to buy the dream home. Let's use London as an example again. And that dream home that they were looking for at the time was maybe £400,000. That could quite easily now be a £500,000 property.
Yeah.
Therefore, they can no longer use those lifetime ISA funds to buy that property, which is a real issue with the lifetime ISA. I'm asked all the time, will they increase the limit? They have to at some point. At some point they have to. Reason being, property prices historically over a longer period are always going to increase.
Yeah.
Therefore, 450,000, there will become a time where that is a ridiculous limit and it's quite clearly unsuitable. At the moment, there's a little bit of a review going on whether or not it's suitable. If you were to ask me, will they change it? My answer would be, I don't know. And that's my honest answer. Reason being, because arguably it should have been changed in the past already and it hasn't been. But fingers crossed.
Yeah, but also when you look at other increases in threshold, obviously coming from a finance background, that got increased from 85 to 90, which just felt meaningless because in real terms that money is now so much more and it should have been increased further. So it might be that they do increase it, but it's not a meaningful increase and it doesn't really affect the large majority of people that are trying to buy in London. Exactly.
So just to throw a figure out there that I feel would be balanced and suitable, and maybe likely is a strong word, but I would say around about £650,000.
Yeah.
I think that's there where it should be. Do you agree?
Yeah, for London or for the rest of the UK.
I think it's easy just to have a limit that's fixed across the country.
Yeah.
To be honest, if it was up to me, I would have that figure for the full country.
Yeah, no, and I think that's so reasonable, especially because, as you say, age for a first-time buyer is going up. You're not just looking for a 1-2-bed house anymore, you're looking more for a family home.
Absolutely. And, the reason that the age is going up is because buying a home is difficult.
Yeah.
It's only getting more difficult. House prices, historically, again, over the long term, are increasing. Wages aren't matching that. There's lots of other moving parts, not enough new homes being built, etc. It's becoming difficult. So, yeah, I completely agree.
Amazing. And so what tips could you give to a first-time buyer for saving towards a house deposit?
If I was to start saving towards a house deposit right now, this is what I would do, assuming that I'm not buying in the next 12 months. Okay, I would open a lifetime ISA. Okay, with the knowledge, and if I have the knowledge that I'm not going to be buying above the threshold, I would open a lifetime ISA. I would begin contributing to that as early as possible. I would also speak to a mortgage advisor to establish and understand how much of a deposit that you actually need. So they will be able to give you a figure of, right, you're probably going to need a minimum of this amount. Therefore, if you're looking to buy a home in the next 3 years, you can, take that amount, divided by 36 months, and that will let you know how much you need to contribute. As well as that, and this is a little bit of an awkward one, maybe, I would understand early if your family are going to gift you any deposit money. People are gifted deposit money. And, some listeners may hear this and think, well, I'm not that fortunate. And, that is the case. I wasn't that fortunate either. But reality is that a lot of people are gifted deposit funds for buying a home. But if you can establish early, if you are being gifted deposit funds, that will give you that clarity of how much you need to save as you move through the next few years. A lot of the time, if parents want to surprise you when it comes to buying a house, might not be, it's still very useful. But if they told you 2 years ago, that allows you to plan accordingly, because buying a home is hard and you need to prepare as much as you can.
Amazing. And so what other hidden costs are there to buying a house?
There are a few potential costs. I'll start with stamp duty. So there's actually a change occurring with stamp duty as of the 31st of March 2025. So what happened was, in 2022, the government increased the thresholds for stamp duty, therefore minimising or reducing the amount of stamp duty people are having to pay, therefore stimulating the market. But the plan was always that on the 31st of March 2025, those thresholds would come back down to where they were previously. So as of the time of this recording, first-time buyers are entitled to something called stamp duty relief, which goes up to £425,000. That means you'll not pay any stamp duty up to that amount right now. However, as of the 31st of March this year, that will reduce to £300,000. So with that, to give you an example, if you were to buy a property for £425,000, whether or not you complete before that date in March or after that date could have a stamp duty difference of £6,250.
That's crazy.
So that's a cost we need to factor in.
If you were going to buy a property after the 31st of March, say for $350, do you pay stamp duty on the whole thing or just above the threshold?
Just above the threshold.
Got you.
Yeah, that's one of the costs. That will become the new norm, I suppose, after March.
Yeah.
If somebody has an ongoing purchase at the moment, you need to be speaking with your solicitor to understand when your completion is going to occur. But yeah, that's just one of many costs.
And what others are there?
So if you are working with a mortgage advisor, mortgage advice fees typically vary for a residential purchase anywhere from £0 to £1,000. Not only does the fee vary, but when the fee is payable, that also changes. That could be payable at decision in principle, mortgage offer, completion. It's different with every advisor. That fee may be broken down to be payable in multiple instalments throughout the process. So you need to understand what fee is payable and when it's payable. As well as that, you may choose to have a survey carried out when you buy a property. Surveys are optional, but they are advisable. You wouldn't buy a £425,000 car and not have a mechanic check it over. Survey fees, depending on the property value and the type of the property, likely anywhere from £500 to £1,000. As well as that, you will need to work with a solicitor when buying a home. So many moving parts with how much a solicitor costs, depending on, again, the property value and whether you're being gifted money, whether it's a leasehold property, whether there's somebody else living in the property with you who's not named on the mortgage, and the solicitor who you choose, anywhere likely from £1,500 to £2,500. I would budget for that.
So basically, when you're saving for a house, don't just save for your deposit, save for all of these other moving parts as well.
Absolutely. But if you're having those early conversations with a mortgage advisor, you'll be able to understand how much that's going to cost in the future. And yeah, make sure that you've got that money available.
Amazing. And so what is something that you wish you knew about mortgages before you started your mortgage process?
We'll just have a think about this one. So one thing I wish I knew before I started my own mortgage process was I wish I chose the right mortgage advisor. because they will guide you through the full process. You want somebody who's in your corner, on your team, working with you. So choosing the right person is key. As well as that, I wish that I chose the right solicitor. I didn't really have a great solicitor. We didn't have a great experience. And again, that can make the process quite clunky as you are moving forward. When it comes to saving a deposit, I wish that I'd had a little bit more clarity regarding how much I was going to need, because we were sort of saving quite blindly when it came to buying our home. As I said, we never really did things very well when we bought our first home. So yeah, I wish I had a little bit more clarity in relation to that. But yeah, those are the key points for me.
Amazing. And so another question around finances is, should you try and clear your debt before you apply for a mortgage? And what sort of impact does debt have on your mortgage?
So debt is factored into affordability calculations. So debt will impact how much you can borrow for a mortgage. Now, reality is, in an ideal world, we would all have no debt. But reality is, people do have debt. People do have car finance agreements, a little bit of credit card debt. Should you clear that debt? In a lot of cases, that's not possible. Reality is, for a lot of people, that's just not possible to be able to get rid of all of their debt. But when you speak to a mortgage advisor, I will look at your income, your debts, your credit history, how many children you have, your age, and all of these different parts will allow me to establish how much you can borrow. When I look at that, I can then let you know, okay, your debt is either not having a negative impact on your ability to buy a home, or it is. Mm-hmm. If it is, I can then let you know which debts are maybe most important to clear. And then you can either choose whether or not you want to do that and whether or not that's possible. But yes, debt management is absolutely key. Lenders also look at things such as your debt to income ratio. So essentially making sure that the amount of your debt as a balance is proportionate to your annual income. Mm-hmm. And also things such as credit utilization. Credit utilization is how much of your available credit you are utilizing. For example, if you have a credit card with a £3,000 limit and your balance is £1,500, your utilization is 50%. If that was the case, we would not necessarily have any issue with your utilization. But if your utilization is 100%, many lenders don't like that, because that suggests that you are reliant on that debt, therefore not managing your money correctly.
And so, how do credit scores sort of work? For example, I don't have a credit card because debt terrifies me, and that's just part of my personal money mindset, my past experiences, looking at other people like in my environment, and so that's terrified me, and so I've gone, oh my god, I don't want to get a credit card because I don't want to end up in debt. But I still obviously have a credit score because I've rented and all that sort of stuff. And so how can you improve your credit score? Because obviously you can go on Experian, like check out your credit score and see what's going on over there, but how do you improve it if it's not looking too healthy?
Okay, so credit scoring is one of the areas that, in my opinion, is surrounded by some of the most myth. There's a lot of misinformation on there. There's a lot of unnecessary information out there regarding credit scoring. Credit scoring absolutely does play a big part in buying a home. When we run a decision in principle and also a full mortgage application, the lender will complete a credit check to make sure that you meet their criteria. Now, each lender has their own credit scoring criteria. There's no one-size-fits-all number out there that we all need to buy a home. That's not how it works. Lenders look at things such as how much debt you have, your credit utilization, are you registered onto the electoral roll? They also will look at, and this is maybe the primary factor, of how you have been repaying your debt. Your credit report is a little bit like a school report. How have you behaved over the last 6 years in relation to your debt? How much have you taken on? Have you missed any payments? Have you had any defaults? Have you had any CCJs? If so, lenders look at when they occurred, when they were satisfied, what were the figures involved, and how many times did it happen. Mm-hmm. Lenders look at that information more so than a score. Lending criteria is, with a lender, as an example, it may be you are allowed 2 missed payments in the last 6 years, but none within the last 6 months. You are allowed 1 CCJ, but it can't be within the last 5 years. These are more so the things that lenders look at, and the criteria points are different for each lender. But quite a big opinion that I have on credit scoring is that, you know, online and TikTok may have you believe in certain apps, not to name them, may have you believe that everybody needs a credit scoring master plan and there's some mystical path to having a credit score that's going to allow you to buy a home. Reality is, if you have an amount of debt that is proportionate to your income and you're not exceeding that, if you have maybe a little bit of borrowing history, it only needs to be a little bit on your credit agreement, on your credit report, and if you've made all of your repayments on time, your credit score will be good enough to buy most mortgage products in the UK. We don't all need a master plan. My biggest credit score tip is don't make a mess of it in the first place. If we can just make our payments on time, we are going to be there or thereabouts. In some cases, I may advise, not all of the time, In some cases, I may advise, right, maybe you do need a little bit more borrowing history. If that is the case, it's putting your petrol on the card. It's putting your groceries on the card. We don't need to take out a car finance agreement. But yeah, some people with bad credit will have that due to bad breakups, abusive relationships, job loss. But I look at credit reports every day. I've looked at hundreds and hundreds of credit reports, and I've worked with hundreds and hundreds of home buyers. And most people have bad credit as a result of a lack of care, a lack of awareness when younger, maybe a lack of respect for certain debts or phone bills, and maybe they don't realise that when it comes to buying a home, these things matter. From being 18, if we just don't make a mess of it in the first place, that's going to stand you in good stead.
And I think that's so true. I think especially when you're younger, you don't realise the effect that your spending habits have when you get older. I wish we were sort of taught that in school to have some sort of awareness for it, because buying a home is such a massive thing and they look at so much history, and also you need so much money to be able to do it, and you can't just like start saving for a year on an average salary. You have to start years before.
The problem is that debt is so accessible that the day you turn 18, you start getting letters through the door offering you credit cards. You know, this debt is so available to us now. It's so easy to get debt. Buy now, pay later.
Oh, and it's so pink and happy and like amazing, and everyone's like, oh my god, you can't afford this £100 thing, but you can afford 20 quid every month. And it's like, stop brainwashing people.
Just avoid unnecessary debt. For example, you've mentioned that maybe you don't have a large borrowing history. If you were thinking, right, do I want to buy a home in the next few years? You might be wondering to yourself, do I need to get some debt to improve my credit score? The best tip is, it's not to download an app, in my opinion. It's to speak to a mortgage advisor. I can look at your credit report and I can let you know what the best route is to proceed. If you need to take on a little bit of debt, I will let you know, but that will mean that you're moving forward with clarity and it's not guesswork. You don't want to be taking on unnecessary debt if you don't have to, because that's just a banana skin. If we can avoid it, we should, financially.
100%. Well, I'll get you to look at my credit score after this, because now I'm terrified.
But the point is, to be fair, is credit scores. So each provider, whether it's Equifax, Experian, TransUnion, they will all have a different credit score.
Yeah.
And each lender has their own credit scoring.
Isn't that so annoying? Do you think it should be more unified?
I think credit scores aren't that important.
Oh,
So it's not so much about the credit score, it's the information within the report. It's, have you missed payments? When did they occur? Are they satisfied? What was the amounts involved? How many times did it happen? That is more important than the score. The score is essentially, you know, the school grade, but everybody's different. And lenders aren't too fussed on what the Equifax score is.
Well, thank you so much. I feel like I'm being educated so much. It's brilliant. Is there anything that you feel like the listeners should know that we haven't covered?
When buying a home, it is all about preparation. It is never too early to prepare. The last thing you want when it comes to buying a home is to arrive at the date when you're ready to go and find out maybe your income isn't enough. Maybe you have got too much debt. Maybe you have got a missed payment that you weren't aware of 3 years ago. Start early. Prepare well, and yeah, when it comes to the time, hopefully you'll be in a good position.
Amazing. And now more onto you as a person rather than mortgages. How did you start posting content on social media?
So I'm a little bit different. So I didn't take a traditional approach in the mortgage industry. I started self-employed immediately as a mortgage advisor with no history in the industry and with no client base. I've never been given clients by anybody else. So with that, I began posting on social media straight away. In 2021, in September 2021, actually. That's when I started. I know that because I started posting when my first child was born, and the account initially was very busy around the time that he was born. Yeah, I had a good start on social media, but that allowed me to kick on. I've been posting on social media ever since, Instagram primarily. I do a lot of podcasting. Last year, in 2024, the vast majority of my clients contacted me after hearing me on a podcast, and then they move on to Instagram, and then they book an appointment via Instagram. But yeah, I think providing information that is accessible, digestible, hopefully even enjoyable for people. Yeah, people like to see that. People like to follow you. They like to follow your account for 6 months before they send you a message. But yeah, social media has been a fantastic opportunity for me and also for my home buyers who've then chosen to work with me, and yeah, had some great results.
Amazing. And so have there been any challenges or sort of drawbacks of building your client base on social media?
Social media is difficult anyway. Social media is relentless. Social media is a job in itself, isn't it? It's quite a commitment. One of the biggest realizations I've had is that social media has to come first before the mortgage advice, but I'll tell you why. Because without the social media, I don't have the home buyers to work with. So I have to be putting out sort of regular informational educational content, which will then allow me to help people to buy a home. So in my opinion, the social media has to come first, and then that allows me to do the job after that.
And so how do you do it? Do you put a day aside a week? Do you just do it as and when?
I like to batch content. So for example, this week I'm in London to record multiple podcasts, but as well as that, I'm hoping to record as much content as possible to post as Instagram Reels on other platforms. Batching content works best for me. I've tried doing the 1 hour every morning. It just doesn't work, especially, I'm a one-man band. I work from home. I have 2 children, a 3-year-old and an 8-month-old. The house is very busy. It can be quite difficult to have a quiet and often tidy house at 9 o'clock in the morning. So for me, having maybe one day where I batch record content, that works best for me.
Amazing. I love that for you. And do you suffer from what I suffer from? Fake accounts?
So I'm not sure. But I don't think so much. However, I have, all of the protection in place, the verified account for that reason. People often ask, why is your account verified, Dan? You've only got 5,000 followers. The reason is because that account is such an asset to my business. So I can't afford to have any sort of duplicate accounts made, any fraud accounts made. I need that account to be protected so that people know it's me.
Yeah.
Especially in finance, there's so many people who are offering crypto advice or investment advice. And I know it's a real problem.
Yeah.
So yeah, I avoid that at all costs.
Yeah, 100%. And I think that's what's so difficult, especially like misinformation. A lot of people will say things to get people's attention. Mm-hmm. But you know what happened to me recently? Old white man made a LinkedIn post about me screenshotting my TikTok content, being like, this is misinformation, blah, blah, blah. This is not an accountant. And I just thought, my certificate's on my wall. But I think sometimes it's difficult because there's so many ifs, buts, maybes in mortgage advice and also in finance and most content in general, that short form content, you can't get all the if, buts, maybes across. You just have to make it generalised. Mm-hmm. So do you find the same thing, and do you wish you did more longer form content? But sometimes I think that's difficult with mortgage advice because you don't know if you're looking at 3 years, 2 years, 1 year, because it's completely dependent on the person's personal circumstances.
I would never go into specific lenders or name lenders or specific rates because all criteria sort of linked to specific lenders. Reason being because all of these things change day to day. So if I was to post that today, next week somebody could tell me it's wrong.
Yeah.
So I avoid that at all costs. My content is bulletproof in terms of being correct. It has to be. But I still have people comment who aren't mortgage advisors who say you're wrong.
Steve Pub, but that's what we call them in accounting.
Yeah, but I'm not wrong, so it's okay. But it's something that you get. I think it comes with the territory, unfortunately. But as long as you're making sure that your content is bulletproof and it is correct, then you don't have to worry about that. Because if somebody does comment something telling you that you're wrong, you can go back quite confidently and explain why you're not. And that's always, let's be honest, it's always quite a nice moment.
It is. It is, honestly. Well, thank you so much for coming.
Thank you very much for having me. It's been a pleasure.